Welcome on board, Sanjiv Bhasin, who's now joining in on the show. Sanjiv, good to have you on board. Maybe the markets are playing catch up, but we sure are, having a stellar performance on the cricket stadium. We're bleeding blue and how?
Yeah, morning, Avan. That was a welcome surprise yesterday. And first time we batted first, and I thought we, performed slightly poorly given our outstanding performance. But the bowlers, they really did us proud. So I think, Avan, for the first time, I've seen such camaraderie in the team, and every department performing. So thumbs up. I think we are going to be the world champions, and the six-leg streak of wins should now convert into even better times, and hopefully that should play out rub out some good effects on the market, where we had six large long days of fall, and I think the results are actually telling you that believe in India blue.
There are times in the market where everything is looking good, but stocks they correct. And are we going through that phase of the market where numbers are okay, banks are strong, but you will still go through a phase of compulsive correction and you need to accept it?
Correct. Good morning, Nikunj. That is the part and parcel of volatility and some, external risk which always plays out. You've seen the numbers from Reliance, from Canara Bank, from Ultratech, from Maruti. It's not just one sector or stock. It's a breadth of the market. And I think that mid caps are also delivering, which is why if you thought there was froth, I think that is unwarranted. I think the broader market, particularly the Nifty and the Bank Nifty, given the spate of earnings and the growth outlook and the seasonal factor, is all looking very, very hunky-dory, Nikunj. We know on the 1st, the Fed is going to be on hold, and the dovish nature of his speech now, given that yields are closer to 5%, should actually abate. Plus, hopefully, there should be some faster resolution on the ceasefire in Gaza and so on. But, we've learned to live with it. How long back have you started to talk about Ukraine and Russia? That's in the past. So I think sooner rather than later, market will focus on better micro earnings. And if anything, I think Reliance needs to be re-rated, which should actually give a leg up to the index, definitely. So I am very, very bullish on both the indices, Nifty and Bank Nifty.
But technically, Bhasin Saab, the view is very different. Nifty has struggled to cross 20,000. We've gone below key technical levels. And if the SGX number or the GIFT Nifty number is anything to go by, we will have an opening in and around 19,000. So does it make sense to go against when the technical setup, at least in terms of the short-term momentum direction, is not favorable?
Yeah, Nikunj, that will always remain a question mark, because I thought that the last 6 days were very, very excessive in their nature of a fall. More due to expiry, more due to a lot of technical factors. But, Reliance, HDFC Bank and maybe a lever have been part and parcel of this larger than expected fall. Now, I am not making the case that outrightly, but remember, in a bull market, these type of corrections also see sharper than expected rises when they come. Secondly, Nikunj, in the last 3 years, we've been in the 17 to 20,000 range, but quietly earnings have started to grow. So now your multiple is not all that expensive, which was touted to be. And I would say that little bit of stability globally. India sets to be the outperforming index. November will maybe much better month than we thought. And as we get through this event risk of the Fed and so on, I think numbers will continue to flatter on the upside. So I can hold my neck out. I think this 18,800, 900 may be retested because of a technical parlance. But these again are buying opportunities, given the macro and the earnings trajectory seems very, very positive. And the outlook also is even more positive than we imagined. At a time when global risk is far, domestic consumption is playing is playing the best play globally.
Okay, I'm just going to change gears and talk about some specifics here. And the specifics, Nuresh, some would argue really would be which way Reliance would move. and which way HDFC Bank would move? Nuresh.
So technically, if we look at it as of now, there is it's been a clear-cut underperformer, and the price action continues to be lower. So if you look at HDFC Bank, it broke the recent swing lows also, which is where it bounced back from that 1490 levels. So technically, it remains weak. The previous gap up moves, etc., have been broken down. So ideally, the trend remains down. It's only when we start making a move beyond 1530 is where we change our view. Now, whether it stops at 1400 or at current levels is tough to say, but the trend is down for HDFC Bank. The stock is back to the prices where it was pre the merger announcement. The lows post that were closer to 1300. The last swing low, major swing low in that period is closer to 1350, 1400. So technically, the trend remains weak. So unless we cross 1530, would not be looking at it. On the same side, Reliance Industries has been a slow and steady downtick here as well. But it's not been a sharp correction. It's been a very slow and steady correction ever since 2600 odd levels. In the near term, there is some bit of support around the 2200 mark. So till the time 2200 holds, we could be seeing some bit of a bounce, but overall, it could be a range-bound stock 2200 to 2350. So not bearish per se on Reliance Industries, but not really a trade here.
Okay, that's the take coming in on Reliance. Indian Hotels, that's going to be the other stock to look out for. Sanjiv, Nikunj is already there at the IHCL headquarters. He's going to be chatting with Puneet Chatwal as well shortly. But what's been your reading of the numbers? While, of course, the US operations were a little bit of a drag, but the India operations are roaring to go. And, you know, the good thing is that the strongest of the quarters is up ahead.
Been the star performer, and it's telling you that average room rates were at an abysmal low during the COVID and the pre-COVID period. You can't get room rates up to 35,000. Mr. Chatwal met me some months back and said, I wish I had more properties in Bombay and Delhi because capacity is running full. You just go to the lobby of Taj and you'll imagine what the buzz around is. There is no place to stand. I mean, literally speaking. And it tells you that entertainment and travel and tourism are actually at the best place ever, and yet raring to go, given that in Delhi now there is a spate of weddings. Your bookings are for banquet halls and the likes are actually at maybe just starting to go reach highs. So I think this is a very, very sweet business. Tatas have been always at the forefront, and I am very, very bullish on this stock itself, which also means that the spending patterns and the consumption patterns are very, very positive. So domestic growth is going to be the key. We'll hear more on what the US operations is, which could have been a one-off, as there is some sort of weakness in the US, and that could play out because of higher inflation. But locally, the top pick continues to be Indian Hotel.
But isn't that price to perfection now? The template that Indians will travel more, Indians will move out more. Isn't that in the price? And also going forward, there will be no upside which will come from G20 and Cricket World Cup.
Yes, you could argue that, Nikunj, but that is what we felt has always been the case for a Nestle or for a Maruti or for an Indian hotel. Pedigree stocks with business outlook and transparency and forward-looking guidance will always trade at perfection to prices, but they always supersede those prices. So Maruti has hit is closer to 11,000. I think 12,000 is very much on the card. Nestle is close to 25,000. I think 27,000 is a possibility. And thirdly, again, Indian hotels. So like you said, yes, a large part of it is in the price. But if you want to be in the pedigree businesses and in the, want to participate in the India story with a slightly longer term view, these are three stocks which must be in your portfolio.
Suresh, Maruti, I mean, it's just been a standout. I would say that if I look at the recent leg, it has underperformed Tata Motors. But last couple of days, it has gained elevation. Do you think Maruti is on course to move to, let's say, 12,000, 12,500 soon?
So yes, Maruti and the whole auto pack has been a relative outperformer to the Nifty. The whole auto pack as such trades above the 50-day moving average, and the Nifty is at the 200-day moving average. Now, Going forward, Maruti has given a breakout, which is almost 5 years. So the last time it was at 10,000 was back in 2017, 2018. Then closer to 8,000, 9,500, 900 in 2022. Then in June, July, we came to that 10,000 mark. So now it's broken that 10,000 mark after 4-5 attempts in the last 5 years plus. So it's a breakout. Did a retest also recently a few weeks back. So overall, structurally, this would imply that it's a trend which has started, which could last almost a year and go much higher going forward. So 12,000 would be a distinct possibility in the short to medium term. And a stop loss would now be placed at around 10,000 odd levels. So it's a buy at current levels as well as on dips with a stop loss below 10,000 and a target price of 12,000. And the whole auto pack looks interesting as such.
In fact, since we're on the subject, let's also hear out what R.C. Bhargav had to say about the numbers.
During this half year, crossed the 1 million mark. We had been waiting for this to happen earlier, but various factors had come in the way. This semiconductor crisis, mostly responsible. It had set back our things because we had hoped to get to 2 million much earlier. But now that we've crossed 1 million in the first half, the probability of crossing 2 million during the year is very, very high now. We are looking forward, and we hope that during this year we will get to that landmark.
Okay, that's the take coming in. And Maruti, remember this week you've got Tata Motors as well coming out with its earnings. But Sanjiv, we'll let you go on that note. Thanks as always for taking the time out and joining in. A week handover, and I just want to revisit what the Nifty implied open is indicating. So from the levels where we left it off on Friday, seems like we're going to consolidate around that mark. But yeah, on a net basis, it's a 47-point decline that you're seeing, 19,097 for the Nifty right now on the Gift Nifty. But with the correction that played out in the broader markets all through last week, what should investors be doing? That's exactly the question that we asked all of our experts who joined us all through last week. Here's a slice of what they make now as to what investors should be doing, whether they should be staying away or using these declines as buying opportunities.
The small cap index itself churns so much that the stocks that finally make that cross that high again are a completely different set from the stocks that fell. The stocks that fell, a lot of them just go out and go to zero essentially, stop trading, etc. So that part of the market I've been saying for the last month and a half, that's where you have the real risk part. The large caps, of course, you have to choose the sectors carefully, you have to choose the companies carefully. I and my systems also don't still like private sector banks. In fact, the last rebalance we did, we cut back banking in general, and within banking, again, skewed little more towards PSU banks.
We like pharma as a sector because we think there's earning resilience in the sector. And more importantly, the sector is coming out of 2 years or 3 years of underperformance and business challenges. And now a lot of those headwinds which the sector faced has turned into tailwinds. So we see good opportunities in pharma across both large caps as well as mid caps, and valuations there are far more reasonable. And apart from that, we like some of the mid cap banks as well, financials as well, because we think asset quality in the sector as a whole is extremely strong or resilient.
We have been a little cautious on the broader market space for some time now. And our broader concerns were that the valuations had become too rich and greed was clearly visible on the street and money making had become too easy. Over the last decade, mid and small caps have been the best equity class. And we believe that some exercise and some caution needs to be warranted in the near and short and near term. Even if you look at large cap market cap ratio versus GDP, it has come down to very reasonable levels. And we believe that some, rotation may happen from mid and small cap in the near term towards large cap, which are in a much better valuation zone.